banks have ended up in the position, as Bernard Hickey has said a time or two on the panel, where they have the franchise on the creation of money. And governments put banks in this position and could very easily change the rules. A revolutionary paper by the International Monetary Fund claims that you could eliminate the net public debt, for example, of the United States at a stroke, and by implication do the same for Britain and Germany and Italy and Japan. Joining us is Westpac New Zealand senior economist Michael Gordon. Michael, good afternoon.
Good afternoon.
So I suppose at the back of this discussion, is there any real reason, we ask, why there has to be this deep and fast-flowing river of capital flowing out of our economy into the banks across the ditch? You've seen, I think, the essential argument. I think we sent you the story out of the Telegraph, which attempts to analyse it, of this interesting paper and widely discussed now out of the International Monetary Fund about whether we could just essentially, flick away all this global debt. Is it possible?
I think it's certainly possible to have this kind of arrangement. This IMF paper is really revisiting a plan that was really born out of the Great Depression in the 1930s. There's a lot of soul searching about how did we get ourselves into this position in the first place, and I think it's sort of come up again, particularly in the Northern Hemisphere, where they are again asking, how did we get ourselves in this position in the first place? I'm certainly not sort of too well versed in the exact details of the plan, but I guess you can sort of really put it on it's on a spectrum of sort of possible plans of controlling the money supply. Really, I mean, money it doesn't have value in itself, but it's a useful thing. So it is useful to sort of have it in society, but you really need some sort of control on it, so you don't have people effectively sort of granting themselves more of this essentially valueless but still useful product.
I don't. Sorry, I didn't mean to interrupt you, but I mean, I don't pretend to understand, and I think the economics editor of the Telegraph is in a similar position. Their entire suggestion, but essentially, isn't it, Michael, that credit cycle trauma caused by private money creation dates deep into history and lies at the root of what they say is necessary to solve the problem, and that's periodic debt jubilees, which used to be held throughout history. And in simple terms, what they're saying is that we're in the kind of impasse that has only been solved in the past by a forgiving of debt, a debt jubilee of some sort. Would that sum it up?
I think that's one aspect of it. This, the plan that the IMF paper was looking at was effectively more about who dictates the overall growth in the money supply. And there are a range of approaches you can take to this. You can ultimately, someone's got to be the adult and sort of say, establish some discipline about it, which is why, for example, we have independent central banks. So this issue of the growth in the money supply doesn't get politicized. And I think we've kind of been through at least a decade or so of a period where central banks, while being independent, were probably a little bit lax. They ran very loose monetary policy. We had very rapid growth in the money supply, very rapid growth in asset prices, but they kind of said, well, it's not our problem. We deal with consumer prices, and I think there's a little bit of soul searching going on all around the world in that aspect of it. I guess the issue about bank profits. I guess my starting point for that is New Zealand still has this imbalance between saving and investment here. We're still effectively borrowing a lot more than the nation saves. That gets funded from offshore, and by and large it gets channeled through banks because they have the name out there and the reputation to raise the money from overseas. And I think to some degree bank profits kind of reflect that the fact that they have that access to international markets. But the bottom line is, even if that wasn't the case, I think we'd still be paying a lot of money offshore. It would just be less in the form of bank profits and more in the form of interest. The fundamental problem is the fact that we have this great need to, or I guess great desire to borrow from overseas in the first place.
The IMF paper, not to get bogged down in it, but one more question on it,
sure.
Is essentially making the point that the control of credit growth would become much more straightforward because banks wouldn't be able, as they are today, to generate their own funding, and which is an extraordinary privilege not enjoyed by any other type of business, says the IMF paper. And banks would become what many erroneously believe them to be today, pure intermediaries that depend on obtaining outside funding before being able to lend. Is there some truth in that?
Well, I mean, I think the proposition that banks make money for themselves, I don't think is right. Banks can create money for their customers, not for themselves. There's quite an important distinction there, and people borrow from banks. They don't do it for fun. There's a reason. There's usually some intent, some understanding that it's going into some productive purpose. But I mean, coming back to the heart of the IMF paper, the idea, it's really more about a shift from the role of credit creation. It's away from banks, but it's really putting more of the onus onto the state, which is why I mentioned you've got to have someone be the adult and someone to actually say, we are going to limit growth in the money supply to X amount. And
Michael, very nice of you to join us on this. Thank you very much. So it's got its gainsayers, but it's also got its supporters. The guy who coined the term quantitative easing, Professor Richard Werner, he says that a switch to state money would have major welfare gains, and he's backed by a few other groups as well. But I think it's regarded at the moment as a fringe paper, but it might not be in a couple of years if nothing else solves the problem.
Yeah, probably, but although you don't want to get the state too heavily involved in monetary systems, if you can avoid it, you should still try to have some kind of a free market,
I think most people would be quite surprised, most lay people were very surprised to learn that the Federal Reserve wasn't in fact part of the American government in any way, shape or form, and was in fact a private bank. And I think most people would probably think that the state was already much more involved in these processes, internationally anyway, than they are in fact.
Yeah.